Highly intelligent, deeply successful professionals, doctors, lawyers, executives, consistently lose their money in the stock market. To understand why, we must examine human biology. We are pattern-seeking animals. Our brains are hardwired to find sequences, predict outcomes, and crucially, stick with the herd. If everyone around us is running, our survival instinct tells us to run too. That instinct is lethal in the financial markets. When prices drop and the crowd panics, investors are swept up in a highly contagious emotional frenzy, buying high out of greed and selling low out of fear. To counter this, the father of value investing, Benjamin Graham, drew a strict line. He defined speculation as gambling on daily stock price movements. Investing, on the other hand, is a quiet, analytical process that promises safety of principle and an adequate return regardless of the crowd. Graham warned that you must never mingle these two approaches. If you want to speculate, keep that money strictly quarantined in a separate account, capped at a tiny fraction of your wealth. The stock market functions like a machine engineered to exploit our biological emotions. To survive it, we need a rigid, mechanical framework to insulate our intellect from our impulses. Graham created a mental model for this framework. Imagine you own a small share in a private business. One of your partners is a remarkably obliging fellow named Mr. Market. Every single day, he knocks on your door and offers a price to either buy you out or sell you his share. Mr. Market has an incurable emotional problem. When he feels euphoric, he sees only massive growth ahead. Terrified that you'll snap up his shares and rob him of future gains, he quotes ridiculously high prices. But he is also a manic depressive. When the news is bad, he sees nothing but doom. Desperate to offload his risk, he panics and offers to sell you his stake for pennies on the dollar. The prices Mr. Market yells through your door have almost nothing to do with the actual underlying value of the business. His quotes are driven entirely by his emotional pocketbook. Because transactions are strictly at your option, you hold all the power. If his price is foolishly high, sell to him. If he is terrified and the price is ridiculously low, buy from him. If the price doesn't make sense, simply ignore him. He will always come back tomorrow. The intelligent investor never lets Mr. Market's mood dictate their decisions. Instead, they let his irrationality serve their portfolio. But knowing that Mr. Market is irrational is only half the battle. How do you actually figure out when his prices are wrong? That requires honest accounting of your own time. This diagram illustrates Graham's first path, the defensive investor. This approach is for those who value their free time over extra returns. They prioritize safety, relying on a passive, diversified portfolio of broad index funds and high-grade bonds, requiring minimal effort. Then there is the enterprising investor. This path treats investing as a demanding business. These investors spend hours digging through financial footnotes, analyzing management, and actively hunting for mispriced assets. Graham was relentless on this point. You cannot be a half businessman. Trying to actively pick stocks without committing the exhaustive, full-time effort of an enterprising investor guarantees disappointment. The return you can expect from the market is not based on how much risk you take. It is strictly proportional to the amount of intelligent effort you are willing to invest. Whether you choose the passive route or the active route, one brutal reality remains. The world is complex, markets are volatile, and human beings make forecasting errors. To survive our own ignorance, Graham distilled the secret of sound investment into 3 words: margin of safety. This chart shows exactly what that means. The margin of safety is the quantitative difference between the true, calculated intrinsic value of a company and the much lower price you actually pay to buy it. As a student of Graham, Warren Buffett built his entire philosophy on this single concept. You don't try to buy a business worth $83 million for $80 million. You cut an enormous margin. Buffett frames it like building a bridge. Engineers will insist a bridge can carry 30,000 pounds, but they only allow 10,000-pound trucks to cross. That heavy engineering cushion absorbs human error, extreme volatility, and bad luck. When you buy a security for significantly less than it is worth, you no longer need to predict the future perfectly. Match your strategy to the time you actually have. Insulate your emotions from the madness of the crowd. And never, under any circumstances, buy an asset without an enormous margin of safety.